In 1843, Britain was sitting on a powder keg of accumulated capital. Industrial profits had been piling up for decades. Government bonds, known as consols, were paying around 3%. For merchants and manufacturers who had grown wealthy on cotton, coal, and iron, 3% was not enough. The spark, when it came, was a technology, the steam railway, and the explosion it triggered would reshape a nation. The Railway Mania of the 1840s was not simply a story of greed. It was a collision between a genuinely world-changing invention and a financial system that had no idea how to value it. When no established framework exists for pricing an asset, prices are set by imagination. And imagination, left unchecked by evidence, tends toward excess. That gap between what railways were worth and what people paid for them is the central drama of this story. At the center of that drama stands one man, George Hudson, a York draper who turned a modest inheritance into a railway empire and whose rise and fall mirrors the mania itself. Before reaching Hudson's story or the crash that followed, it helps to understand what railways actually were, what they replaced, and why the early financial results made the coming frenzy feel, at first, entirely reasonable. To understand why Britain lost its collective financial mind over railways, start with what existed before them. Movement was slow. It was expensive, and for a rapidly industrializing economy, it was becoming a serious constraint. A coach on a turnpike road averaged around 10 miles per hour. Freight moved by canal barge, which was cheaper than road haulage, but still measured in days between cities. Moving a ton of coal from a mine to a factory was a significant cost embedded in every manufactured good. The entire economy bore the weight of slow, expensive transport. Railways did not improve on existing transport. They made it obsolete. The core technology was deceptively simple. A steam locomotive burns coal to heat water, producing high-pressure steam that drives pistons back and forth. Those pistons connect via cranks to the driving wheels. Iron rails beneath the wheels reduce rolling resistance by roughly a factor of 10 compared to road surfaces. Put those two things together, and a machine that would struggle to pull a heavy cart on a dirt road can haul hundreds of tons at 30 to 50 miles per hour. The physics were not magic, but the practical effect felt like it. The proof came in 1829 and 1830, on a stretch of track between Liverpool and Manchester, and what happened there changed everything. The Rainhill trials of 1829 were a public competition to find the best locomotive design for the new Liverpool and Manchester Railway. George Stephenson entered his machine, the Rocket. It completed the course at 29 miles per hour, roughly 3 times the speed of a fast coach. The crowd was astonished. The Rocket won. The opening of the Liverpool and Manchester Railway in September 1830 brought its own drama. William Hudson, a member of Parliament and former cabinet minister, stepped onto the track during a stop and was struck by the Rocket. He became the first person killed by a steam railway. The tragedy was real, but it did not slow the line for long. What followed financially was the number that mattered most to investors. The Liverpool and Manchester Railway paid annual dividends of 9 to 10%. Government consuls were paying around 3%. The comparison was stark and impossible to ignore. The Liverpool and Manchester Railway demonstrated that railways were not just engineering achievements, they were money-making machines. The economics of a railway have a specific structure that made them look extraordinarily attractive on paper. Fixed costs were enormous: track, locomotives, stations, land acquisition. But once those costs were paid, each additional passenger or freight shipment cost very little to carry. Economists call this a high fixed cost, low marginal cost business. It means that as traffic grows, profits grow faster. And on any given route, the first railway to arrive tended to dominate, because building a second set of tracks alongside the first rarely made economic sense. The prospect was near monopoly profits, compounding over time. Building on that proof of concept, a first wave of serious railway construction followed through the 1830s, and the results reinforced the case for investment. The Grand Junction Railway opened in 1837, connecting Birmingham to Liverpool and Manchester, creating the first long-distance trunk route in the world. 4 years later, Isambard Kingdom Brunel completed the Great Western Railway from London to Bristol, a line built to a broader gauge than Stephenson's and engineered to a standard of ambition that matched its builder's personality. Both lines paid consistent dividends. Both demonstrated that the Liverpool and Manchester result was not a fluke. By the early 1840s, the trunk routes connecting Britain's major cities had been built and had proven their financial viability. That fact is important. The first wave of railway investment was largely rational. The conditions that turned rational investment into mania were created not by railways, but by the broader economy. In the early 1840s, the Bank of England cut its lending rate. Yields on consols fell. Accumulated industrial profits sat in the hands of merchants and manufacturers, earning returns that felt increasingly inadequate. The 8 to 10% dividends paid by established railways were not just attractive in comparison, they were extraordinary. Capital began flowing toward railway shares with a logic that was, at this stage, entirely defensible. But railways had one feature that would prove critical once the flow of capital became a flood. Every new line required an Act of Parliament. A promoter who wanted to build a railway could not simply buy land and lay track. Parliamentary approval was mandatory. That meant depositing detailed plans with the Board of Trade, paying surveyors and lawyers, surviving committee hearings, and competing against objections from landowners, canal companies, and rival promoters. The process was expensive, slow, and demanding. In the early years, this requirement acted as a filter. Only schemes with genuine financial backing and credible engineering could survive it. The parliamentary process gave investors a degree of confidence that a proposed line had been scrutinized. That filter would not hold. Within a few years, the volume of schemes submitted would overwhelm Parliament's capacity to evaluate them, and the scrutiny that had once provided a check on excess would become a formality that promoters learned to game. But in the early 1840s, the system still worked roughly as intended. Railways replaced a slow, expensive transport system with something faster and cheaper by an order of magnitude. The Liverpool and Manchester proved the financial model. The trunk lines of the 1830s confirmed it. Falling interest rates made railway dividends look spectacular, and Parliament's gatekeeping role gave early investors confidence. Every ingredient for a rational investment boom was in place. What came next was the moment when rational became something else entirely. Between 1843 and the summer of 1845, the pace of railway promotion accelerated from a trot to a gallop. What had begun as a rational response to proven technology and attractive dividends was becoming something qualitatively different. The numbers tell the story plainly. In 1843, a handful of railway bills were submitted to Parliament. By August 1845, over 600 proposed schemes were seeking authorization. The combined projected capital expenditure of these proposals reached approximately £500 million. That figure was roughly twice Britain's entire annual economic output at the time. The scale of capital being sought had already detached from any realistic assessment of how much railway Britain actually needed. Yet the mechanism that drove the boom made it easy for individual investors to participate without fully grasping that scale. Investors did not pay the full share price when they subscribed to a new railway. They paid a deposit, typically 10%. The remaining 90% would be called up in installments as construction proceeded, if it proceeded at all. This arrangement had a powerful effect on behavior. A speculator could control £100 worth of railway shares for just £10 down. If the share price rose by 20% before the next call was due, the speculator had doubled their initial outlay. The leverage was enormous, and leverage in a rising market feels like genius. No figure embodied the boom more completely than George Hudson, and understanding his methods reveals how the entire period operated. Hudson had started as a linen draper in York. In 1827, he inherited £30,000 from a relative, a sum large enough to matter, but not large enough to make him truly wealthy by the standards of the day. He used part of it to buy into the York and North Midland Railway and cultivated a friendship with George Stephenson, whose name and reputation opened doors that money alone could not. Through the late 1830s and early 1840s, Hudson acquired, merged, and maneuvered his way to control of over 1,000 miles of railway by 1845. He became known as the Railway King. Politicians courted him. Aristocrats sat on his boards. He was elected Member of Parliament for Sunderland. His method for maintaining investor confidence was simple and fraudulent. When his railways did not earn enough to pay the dividends he had promised, he paid them anyway, drawing on capital raised from new share issues. Investors saw consistent returns and assumed the underlying business was performing. The accounts concealed the reality. During the boom, nobody looked closely enough to find the problem. Hudson's fraud was invisible precisely because the atmosphere of the boom made scrutiny feel unnecessary. The infrastructure supporting the boom extended well beyond any single promoter. An entire industry had grown up around the business of launching railway schemes. Newspapers dedicated entirely to railways, including the Railway Times and the Railway Chronicle, published prospectuses daily. Each prospectus followed a recognizable format, a promising route, optimistic traffic projections, and a list of distinguished names on the provisional committee. Promoters paid aristocrats and members of parliament a guinea per committee meeting simply to appear on the letterhead. These figures, known as guinea pig directors, contributed nothing except social credibility. Their names implied scrutiny that had not occurred. Engineers were hired for the same credibility-lending purpose. A scheme with Stephenson's name attached, or Brunel's, attracted subscribers regardless of whether the great engineer had done more than glance at a map. The professional class surrounding railway promotion, surveyors, parliamentary counsel, solicitors, and agents earned substantial fees whether or not a single rail was ever laid. Their incentives pointed firmly toward encouraging more schemes, not fewer. The geography of proposed lines in this period reveals how far the investment rationale had shifted from economic need towards speculative opportunity. The first wave of railways had built the obvious routes: London to Bristol, Birmingham to Liverpool, the major trunk connections. By the mid-1840s, those routes existed. The new schemes were filling in the gaps, and then filling in the gaps between the gaps. 2 or 3 companies simultaneously proposed to connect the same cities by competing routes. Branch lines reached into sparsely populated rural areas where passenger numbers could never justify the construction cost. Traffic projections in prospectuses took coaching-era passenger figures and multiplied them by optimistic growth assumptions, producing numbers that looked plausible in isolation, but were collectively impossible. The investment rationale had shifted from asking whether a railway was needed to asking whether its shares would rise. The social profile of investors was also changing, though the full democratization of speculation still lay ahead. In the early boom phase, subscribers were still predominantly merchants, manufacturers, and professional men with genuine capital. They could absorb losses in principle. But the share lists filed with Parliament already showed a widening circle. Rising prices attracted attention. Neighbors and colleagues reported paper profits. The population of people watching railway shares grow was larger than the population of people who had yet bought them, and that gap was closing. The boom phase built a self-reinforcing system: cheap entry through deposits, credibility manufactured by famous names, professional fees that rewarded promotion over prudence, and rising prices that attracted new participants. Each element fed the next. The question was no longer whether railways were a good investment. The question, for most participants, had become how quickly they could get in. By the autumn of 1845, the boom had become something harder to describe with financial language alone. The numbers were extraordinary, the behavior was stranger still, and the gap between what was being promised and what could possibly be delivered had grown so wide that only the psychology of a crowd could explain why it was not obvious to everyone. The Times estimated that over 800 railway schemes were simultaneously seeking parliamentary authorization that autumn. On a single day in November 1845, railway prospectuses in the London Gazette filled 16 pages. The combined projected capital of all proposed schemes exceeded £500 million, a sum greater than the entire money supply of Britain at the time. The total capital being sought by railway promoters in late 1845 was physically impossible to raise, even if every investor in Britain had committed every pound they possessed. That mathematical impossibility did not stop the subscriptions from arriving. The reason lies in who was now subscribing and why. Parliamentary inquiries and newspaper accounts from 1845 document the full social range of participants. Clergymen invested the income from their livings. Governesses committed their savings. Widows redirected annuities that represented their entire financial security into railway shares. Charles Dickens was watching. He satirized the type in Dombey and Son, a novel he began publishing in monthly installments in 1846, capturing the figure of the respectable, financially naive investor swept up in the railway moment. The share lists filed with Parliament told the same story in columns of names and addresses. Thousands of small investors appeared, many with no professional connection to commerce or finance, and no framework for evaluating the schemes they were joining. Speculation had become a social activity, driven as much by what neighbors were doing as by any assessment of railway economics. Among those participating, a specific type of operator had emerged who made the euphoria worse by design. Professional speculators, known as stags, subscribed to every new share issue with no intention of holding the shares. Their plan was to receive their allotment, wait for dealings to open, and sell immediately at a premium. In 1844 and into 1845, this worked reliably. New issues opened above their subscription price almost without exception. The profit was quick, the risk felt minimal, and word spread. As more stags entered the market, they created artificial demand at the subscription stage, inflating the apparent popularity of new schemes. Promoters saw oversubscribed issues as proof of investor enthusiasm. They launched more schemes. More stags subscribed to those. The cycle fed itself, detached from any underlying assessment of whether the railways in question would ever carry a passenger. The prices being paid in this environment had lost their connection to the revenues railways could realistically generate. Shares in proposed railways, lines that had not yet received parliamentary authorization and had not laid a single yard of track, traded at premiums of 20 to 50% above their par value. To justify those prices through dividends alone, the railways would have needed traffic volumes that the projections in their prospectuses could not honestly support. Those projections were built on a structural dishonesty. Promoters took passenger numbers from the coaching era and applied growth multipliers that assumed railways would attract not just existing travelers, but entirely new ones, in numbers that grew year on year without limit. The assumptions were not random errors. They were the assumptions required to make the numbers look attractive, reverse-engineered from the desired conclusion. Rational valuation had not been suspended by ignorance. It had been replaced by the desire to participate in something that appeared to be working. Government had attempted to impose some order on the industry the year before, though the attempt fell well short of what the moment required. William Gladstone's Railway Regulation Act of 1844 introduced two significant provisions. The first required every railway to run at least one train daily carrying third-class passengers at a maximum fare of 1 penny per mile. These became known as parliamentary trains, and they represented a genuine commitment to public access. The second provision gave the government an option to purchase profitable railways after 21 years at a price based on their earnings. The intention was sound. The effect on speculation was negligible. Promoters absorbed the parliamentary train requirement as a minor operating cost and largely ignored the nationalization option as a distant hypothetical. The Act did not address the fundamental problem, which was the volume and quality of schemes being authorized. The physical deadline of November 30th, 1845, the last date for depositing railway bills with Parliament for the coming session, produced scenes that captured the full absurdity of the moment. Surveyors worked by torchlight through autumn nights to complete the plans required for submission. Solicitors' offices stayed open through the night in the final days. Messengers on horseback and by rail raced documents toward London from across the country. More than 600 bills were deposited before the deadline closed. The Board of Trade, a small government department with limited staff, was expected to evaluate all of them. The process that had once filtered out weak schemes had been overwhelmed by sheer volume. Parliamentary scrutiny The mechanism that had given early railway investment its credibility had become a formality. Some voices tried to cut through the noise, though they struggled to be heard. The Economist, founded in 1843 partly to provide clear-eyed economic commentary, published increasingly alarmed editorials through late 1845. A small number of analysts pointed out the arithmetic problem. The combined capital being sought exceeded what Britain could possibly mobilize. But these warnings ran against the grain of lived experience. People around them were making money. The technology was visibly real. Trains were running. Dismissing the railway as a speculative excess required arguing against evidence that was, in one sense, right in front of everyone. The Euphoria phase was not irrational in the sense of being random. It followed a logic. Rising prices rewarded participation, social proof encouraged entry, and the genuine reality of railway technology made skepticism feel like a failure of imagination. The problem was that this logic had no mechanism for self-correction. Prices could only keep rising as long as new subscribers kept arriving, and the pool of new subscribers was not infinite. Bubbles do not burst because the crowd suddenly regains its senses. They burst because something external changes the cost of holding on. In the case of Railway Mania, that something was the Bank of England, and it acted in late 1845 for reasons only partly connected to railways. Britain's gold reserves were falling, capital was flowing abroad, poor harvests were forcing grain imports, which had to be paid for in gold. The bank raised its lending rate to defend the reserves. Money became more expensive, and the moment money became more expensive, the arithmetic of railway speculation changed entirely. When the Bank of England raised its lending rate, the 3% consol yield that had looked pitiful against railway dividends began to look reasonable again. Investors who had borrowed to buy railway shares faced higher costs on those borrowings. The expected returns from proposed railways, already dependent on optimistic projections, now had to compete against a safer alternative that had just become more attractive. The marginal buyer of railway shares stepped back. Prices began to fall. Falling prices triggered a self-reinforcing process. Investors who had borrowed to buy shares faced margin calls and were forced to sell, pushing prices lower still. Meanwhile, railways that had received parliamentary authorization began issuing calls on their shareholders, demanding the remaining 90% of the share capital that subscribers had deferred when they paid their 10% deposits. An investor who had subscribed to £100 of shares for £10 now faced a legal demand for £90 more, in a falling market, often for shares now worth less than the call itself. The leverage that had amplified gains on the way up amplified losses on the way down with equal force. The price data from this period makes the scale of the collapse concrete. The Economist's railway share index had peaked at approximately 166 in mid-1845. By late 1849, it had fallen below 60, a decline of more than 60% from the peak. Individual shares fared worse. Many that had traded at £100 fell below 10. Dozens of proposed lines never received authorization. Others received authorization, began construction, and were then abandoned when the calls could not be met and the money ran out, leaving half-built earthworks and incomplete tunnels scattered across the countryside. Behind the price data were human lives, and the human cost was severe. Parliamentary records and contemporary accounts document thousands of insolvencies across the country. The railway writer John Francis, surveying the wreckage in 1851, estimated that the mania had destroyed more private fortunes than any event since the South Sea Bubble of 1720. The investors who suffered most were not the wealthy speculators who had the resources to absorb losses or the legal sophistication to evade calls. They were the clergymen, the widows, and the governesses of the previous chapter, people who had committed savings they could not replace to shares they did not understand, and who now faced legal demands for money they did not have. Families who had overcommitted on deposits found themselves pursued through the courts for the remaining calls. Middle-class households were destroyed. The social damage was concentrated precisely where it could least be absorbed. Among the wreckage, one fall was more spectacular than all the others, and it carried a moral weight that Victorian Britain found deeply instructive. George Hudson's empire began to unravel in 1849. Investigations triggered by falling share prices and suspicious shareholders revealed the full extent of his methods. He had paid dividends from capital rather than earnings, creating the appearance of profitability where none existed. He had manipulated share prices. He had awarded contracts to companies in which he held undisclosed interests, profiting personally from transactions his shareholders funded. Stripped of his chairmanships and his parliamentary seat, Hudson fled his creditors. He spent periods abroad to avoid arrest for debt. He was eventually imprisoned briefly. He died in 1871, in poverty, the railway king reduced to a cautionary tale that Victorian moralists repeated for decades. The crash did not occur in isolation. Its effects spread through the broader economy. The Railway Mania had absorbed enormous quantities of capital through the mid-1840s, capital that might otherwise have funded other industrial investment or provided a buffer against economic shocks. When the crash came, it contributed to a credit crunch that deepened the economic depression of 1847 and 1848. These years coincided with the worst period of the Irish famine, and while the mania did not cause that catastrophe, the financial disruption it helped produce made Britain's economic and political capacity to respond even more constrained than it might otherwise have been. The financial damage of the crash was real and lasting. The physical legacy of the mania was something else entirely. Approximately 6,000 miles of railway were built during and immediately after the mania period. Many of the lines that ruined their investors were nonetheless completed and put into service. They connected cities that had previously been separated by days of travel. They slashed freight costs, unified national markets, and enabled the movement of goods and people at a scale and speed that the pre-railway economy could not have imagined. The mid-Victorian economic boom of the 1850s was built in part on the infrastructure that the mania had financed, at terrible cost to those who financed it. The episode also produced lasting changes to the legal and regulatory framework governing investment. The Railway Clearing House, established in 1842 and expanded after the mania, standardized ticketing and revenue sharing between the many competing companies, making the network function as a system rather than a collection of disconnected lines. Parliamentary scrutiny of new railway bills was tightened. And the broader debate about corporate accountability that the mania had forced into public consciousness contributed to the eventual passage of the Joint Stock Companies Act of 1856, which introduced limited liability for shareholders. That reform transformed British corporate law, making it possible for ordinary investors to participate in large enterprises without risking everything they owned beyond their initial investment. The crash destroyed fortunes, ended careers, and contributed to years of economic hardship. George Hudson's fall gave the episode its human villain, but the railways themselves remained, carrying passengers and freight across a network that would define British economic geography for the next century. The technology was real. The valuations had been insane. Both things were true simultaneously, and that tension is the episode's essential lesson. History does not repeat itself, but financial manias follow a recognizable pattern with enough consistency that the pattern itself is worth naming. The Railway Mania of the 1840s is not just a historical episode. It is a template, and the template has been used again, with variations, in every generation since. The comparisons that follow are structural, not superficial. The point is not that railways and the internet are similar technologies. The point is that the mechanism driving the investment behavior, the sequence of displacement, leverage, democratization, valuation detachment, and liquidity-triggered crash, appeared in each case with enough precision to suggest something durable about how human beings respond to genuine innovation under financial pressure. The dot-com boom of the late 1990s and its collapse between 2000 and 2002 is the closest structural parallel to Railway Mania that the modern era offers. The displacement event was the commercialization of the internet. Like the Liverpool and Manchester Railway, the early internet had proven its value before the mania began. Companies like Amazon, founded in 1994, and the Netscape browser, released in 1995, demonstrated that the network could carry real commerce. The technology was not imaginary. What followed was the prospectus culture of the 1840s, translated into venture capital and initial public offerings. Capital flooded into any company whose name ended in .com, regardless of whether the business had revenue, a credible path to profit, or even a clear explanation of what it did. Metrics like eyeballs and mindshare replaced dividend analysis, just as railway promoters had replaced earnings scrutiny with optimistic traffic projections. The Nasdaq Composite fell 78% from its peak in March 2000 to its trough in October 2002. That decline is comparable, in magnitude and speed, to the collapse of the Economist's Railway Share Index between 1845 and 1849. And like the railways, the underlying technology survived and eventually delivered on its promise. Amazon, Google, and the internet infrastructure built during the boom transformed the global economy. The investors who bought at the peak still lost most of their money. The cryptocurrency booms of 2017 to 2018 and 2020 to 2021 map most closely onto the euphoria and democratization phase of Railway Mania. The mechanism of entry was simplified to the point where almost anyone could participate. Mobile apps allowed retail investors to buy tokens with a few taps, analogous to the simplified share subscription process that had drawn clergymen and governesses into railway shares. The proliferation of thousands of altcoins, cryptocurrencies with no clear use case and no underlying revenue, mirrors the 800-plus railway schemes of 1845, most of which had no credible economic rationale. The stag behavior was reproduced almost exactly in the initial coin offering market, where participants subscribed to new token issues with no intention of holding them, planning to sell immediately when trading opened. The profit was quick, the cycle was self-reinforcing, and the eventual collapse followed the familiar pattern of leveraged positions unwinding into a falling market. Every mania also produces its Hudson, a figure who uses the credibility-lending function of a boom atmosphere to conceal fraud behind a facade of genuine innovation. Bernie Madoff operated for decades, but his fraud became invisible during the boom years of the 1990s and 2000s because the atmosphere of rising markets made consistent returns seem plausible rather than suspicious. Elizabeth Holmes at the Ranos exploited the specific credibility of Silicon Valley's technology culture, surrounding herself with distinguished board members in precisely the way Hudson had surrounded himself with aristocratic guinea pig directors, using the names to deflect scrutiny that might otherwise have found the fraud beneath. The parallel is not that all innovation is fraudulent. It is that euphoric atmospheres suppress the scrutiny that would normally expose fraud, and that the fraudsters who thrive in those atmospheres are those who understand how to borrow credibility from the genuine innovators around them. In every episode, participants constructed a narrative explaining why historical valuation methods no longer applied, and in every episode, they were wrong about valuations even when they were right about the technology.